Welcome to Industry Focus, the show that dives into a different sector of the stock market every day. Today is Wednesday, February the 27th, and we're talking healthcare. I'm your host, Shannon Jones. First up, I'm joined via Skype today by healthcare guru Todd Campbell. Todd, as always, welcome. So glad to always chat with you.
Great to be back here once again and to do something slightly different for this week's show.
Oh, yes. We have a very special treat indeed. And as wonderful as Todd is, we've got another guest joining us this week. And that is none other than Joel Marcus, the executive chairman and founder of Alexandria Real Estate Equities, Inc. For our listeners out there, that's ticker symbol ARE, a company that's really affectionately been called biotech's biggest landlord. I kind of like that title there, Todd. What do you think?
I think so, too. I mean, it's absolutely a powerhouse company, and I'm just really excited, Joel. Thank you to talk to us and our listeners about what's going on in Alexandria. And I thought maybe just to kick things off, for some of our listeners that maybe aren't so familiar with Alexandria, could you give us an elevator pitch explanation of the business and perhaps take a second and just educate us all on the idea of concept of clustering?
Sure, and it's a pleasure to be here, both Shannon and Todd. Thank you very much. Yeah, Alexandria actually, I think we are the biggest, but we certainly hope to pride ourselves on being the best, the highest quality, delivering the best environments for creative genius to create the medicines of the future to hopefully cure a lot of pretty tough diseases that are, have not been challenged. Before I kick off, as you said, the elevator pitch and a little bit about clustering, I would say that keep in mind there are 10,000 known diseases to mankind or personkind today, humankind, but only about 500 have been addressed by therapies, and very few of those are cures. So you can see we're in the really early days of the biology revolution to understand very complex systems within the human body. And so Alexandria, I mean, if you think about us, really with three kind of pillars. One is our unique strategy. We really came up with the idea of laboratory assets that could be bought, developed, redeveloped, and leased to the very inventive research industry, which is creating medicines. And we started back in 1994, really as a garage startup, $19 million Series A. So we started much like a lot of the healthcare startups of today. The second thing is our people. I think that really distinguishes us. We have one of the lowest turnovers in corporate America, and we have, I think, just very fortunately attracted and retained a tremendous group of people, very long tenured people. And I think the model that we try to fashion ourselves after is Jim Collins and kind of level 5, egoless leadership and egoless execution of what we do every day. And then the third kind of pillar to the company is really the financial strategy. And so we started as a private company. We went public. We got our investment grade rating right after the big recession. And we've tried to keep very low leverage and lots of dry powder to grow the business. We've, I think, been very successful with combining that unique business strategy, a very unique talent base, and with a very conservative financial strategy. And when you talk about clusterizations, the company was a single asset. Either we acquired, we built, or we redeveloped. And then in 2004, 2005, 2006, we actually pivoted the company from single assets to the concept of cluster locations. And that was really done at really based on the learnings of the Michael Porter, the famous Harvard professor who really kind of did the definitive work on clusterization. And his thesis was, industries, when they cluster together, they're more productive, you can attract better people, and they just operate in a much better fashion when collaborating and innovating together. And that really is the hallmark of the life science industry. And so in '04, we started Mission Bay in San Francisco, which today is, just an amazing place of, literally, well over 5 million square feet of commercial space. And then there's another similar amount, UCSF's principal research headquarters. In '05, we started our New York campus with Mayor Bloomberg. And today that's almost 1 million square feet in the heart of the East Side Medical Corridor. And '06, we bought Technology Square from MIT. And we also started a 2 million square foot development in the heart of East Cambridge. So those were pretty influential pivot points for the company.
Yeah, and it's just fascinating, this concept of these clusters. Having worked in one of those clusters, Research Triangle Park, to your point, I mean, you've got talent, you've got resources that can really help and grow these businesses as they're clustered. One of the other fascinating things is just how this company got started. Joel, you mentioned this got started in a garage. How in the world did this all come about?
Actually, a little worse than a garage. So I was doing a public offering. I was an attorney, a partner in a large West Coast law firm specializing in biotech and technology. I was doing a public offering for a group, and the chairman called me over at a meeting and said, gee, we have this idea. This was Joe Jacobs, who founded Jacobs Engineering, that we want to create a real estate company. Jacobs has lots of clients in this industry, but we're a service company. We'd like to invest. And so would you help us put together a business plan, a financial model? I did that. And after about a year of putting that together, they said, well, we're too old to kind of run it. Will you help? Would you come in and run it? And I turned them down 3 times and then finally said yes. So they were very persistent. And the focus was to create a new real estate category, really the office laboratory property. And in those days, it really wasn't identified as a separate asset class like you might think of apartments, industrial, shopping centers, et cetera. It just was never on anybody's radar. And so we raised $19 million, kind of family and friends and a few sophisticated investors led by Jacobs Engineering, and really started the company from scratch. We had, when we opened the doors in January of 1994, we actually had a business plan and a financial model and a strategy and $19 million, but we had no other assets. So we're very proud that today the company is almost a $20 billion total enterprise company, really spanning all the great East Coast and West Coast life science clusters. And we hope it's not only providing infrastructure, but venture, thought leadership, and we're very focused on corporate social responsibility. So we really try to be a mission-driven company.
From humble beginnings, right, Joel? Spawns this.
And we try to stay that way. We always think of ourselves as Avis, not Hertz in the old days. Always think of ourselves. If you Jim Collins teaches in his famous book, How the Mighty Fail, you don't want to be a company like Kodak hanging out in Rochester, New York, not able to recruit young, really innovative people and not taking on the digitization of, photography. So we try to stay leading edge, and that's why, we have a team of scientists and technologists, and we try to stay at the leading edge of the learnings in our focus area.
And I imagine that's incredibly important. And, I want to shift gears slightly to discuss that a little bit, flesh that out just a little bit more, because we know that this is a very innovative industry that you're serving. Tremendous amount of innovation that's going on, and it seems to be happening faster and faster and faster. And you've got a specialty niche here where the real estate that you're building out is very specific. It's specific to these types of tenants. So of course, one of the questions then that would come up would be, okay, well, what are the levers that drive, or the pillars that support occupancy rates within your buildings? Because obviously my assumption would be that, if these pillars were weaker, then it would be tougher to fill those spots because they are so specialized.
So that's a really critical question, and we really attacked that very early on because this is kind of a funny story. When we went for our Series B round, we had 30 meetings set up by our investment bank, and literally 28 or 29 of them we got tossed out. Some even saying when we came in, I remember a major, I think it was GE pension fund, said, "Oh my God, we own one of these buildings and it's a disaster. We'd never invest in this." And finally, there was one pension fund that decided to fund our Series B that bridged us to an IPO. But it turns out we investigated that and thought, what's this building? Well, it turned out they owned a industrial building that had printing solutions and it had nothing to do with research of biology or chemistry. So it was a misperception totally. But the concept is this is a specific industry. The buildings we buy on occasion, we mostly develop, and we do some redevelopment, are above standard. They're more expensive than office buildings. They have specific infrastructure which bring water, gases, and substantial air to the laboratory bench. And so if you build one of these and you put this infrastructure in and somebody moves out, you don't want to rip all that infrastructure out. That would be a huge waste of money. So we decided that we needed to focus on dense areas where these companies cluster so that you would not have, if one tenant moves out, you don't then have to lease to, Goldman Sachs or, a JP Morgan or an traditional office tenant. That would not be a very good outcome. So that's where the cluster theory really emerged in a very dramatic way, because when you operate in the clusters, you have great depth of tenant base, multiple types of tenants from early stage to late stage to mid stage, and it's a very, very important factor.
So let's talk about where the company is headed maybe over the next 5 to 10 years, and maybe some of the factors that are driving your growth strategy moving forward.
Yeah, that's a great question. And so, let me go back to just the other one before. So because we're involved in the key clusters, Seattle, San Francisco, San Diego, Cambridge, New York City, the Maryland area, and North Carolina in the ag tech area, the depth of the tenant base is such that when one tenant moves out, another tenant can move in, and we don't have to spend a lot of money to re-tenant and refit the properties, and that's been very helpful. When we look out on, we did our investor day on November 28th here in New York City, and we gave earnings guidance, naturally, as companies do, for 2019. But we did something, we broke with tradition and gave a framework for a 5-year plan that would enable us to double the rental revenues of the company on the assets we own today, not only the income-producing assets, but the great land assets we have in the clusters I just mentioned. And so we took the analysts and institutional investors through our 5-year plan and said from the beginning of 2018 to the end of 2022, we have a good chance, assuming there are no terrible black swan macro factors that would impede that, we can double the rental revenues. And I think that's pretty unusual for any public company, let alone a REIT.
Yeah, doubling rental revenues is huge. So I commend you for the challenging stretch goal there.
Thank you very much.
Joel, you brought up a good point there. You talked about black swans, those things that just can come out of nowhere. And I know that when I think about my business, I have some of these sleepless nights. I'm curious, what is it that makes it tough for you to get to sleep at night? What are those events that could happen? I mean, is it simply rising interest rates and what the impact could be then on building new buildings or economic recession, or what are the things that worry you?
Yeah, that's a good question. So one thing that doesn't worry me is we have our average lease is about 10 years. More than half our leases are investment grade or large cap companies. So I wouldn't do this, but if we went to sleep as a management team, we could maintain half our revenues with the highest quality tenants for 10 years. But we won't do that. So we do feel good about sleeping at night. We're not so worried about interest rates. I think the Fed has done a good job of managing the careful unwinding. In fact, Jay Powell's testifying today to congressional committees, done a good job of laying out the pathway to unwind the balance sheet and to carefully raise interest rates. I don't think you can assume that past interest rates levels are ones that we would have for the future. So I think they're gauging that very carefully. We're also a very lowly levered company. We have very little, less than 5% of our debt is variable rate debt, meaning all of our debt today is fixed at, and we just got our upgrade from S&P. So both S&P and Moody's rate us at BBB plus investment credit, which is great. So we don't have much exposure to variable rate interests. But what is an existential threat that is out there, and part of what's going on in Congress as well, is the health of the industry. And we want to make sure that this country leads the world as it is today in biomedical innovation. And you go back to my opening comment, if we have 500 addressable therapies, only a few of which are cures out of 10,000 diseases, we've got a long way to go to really help humankind stay healthy. So we need to see positive NIH funding, which we have, positive medical research philanthropy, which we've seen, a great regulatory environment for the FDA, and Scott Gottlieb, a real shout out for he and his entire team. They've done an absolutely first-class job. Venture and public market capital flows being positive, and the companies, both biotech and pharma, reinvesting in a R&D funding, and this is where drug pricing comes in. And hopefully one will see drug pricing is not just a list price by the manufacturer, because 40% literally goes off the top to middlemen. And then when the end user gets it, usually the hospitals sometimes mark it up, from, 1 times to 10 times. And they use that as a way to offset their losses through other mechanisms that they have, where they have their emergency rooms being used by people who can't pay and so forth. So it's not the manufacturers oftentimes that are the problems. There have been some egregious kind of crazy people, but the mainstream, really high quality, ethical groups, we want to make sure that they have an incentive to continue research and development and great breakthroughs, especially on the precipice of a generation of dementia and really serious neuroscience diseases that are going to take hold here over the next quarter of a century.
Yeah, I totally agree. And you really hit the nail on the head in talking about the importance of the U.S. really being at the forefront of biomedical innovation. A couple of stats I came across as I was just researching the company. Silicon Valley Bank actually recently ranked ARE as the most active biopharma investor by deal volume in 2017 and 2018. And Forbes ranked your company as #1 in terms of venture capital in the healthcare sector, also on deal volume in 2018. Pretty impressive. What can you tell us about your venture capital arm, and maybe what are some of your specific focus areas too?
Yeah, well, you are a good person to ask because I know you have a neuroscience background, Shannon. So yes. I appreciate the question very much. I think, we are #1 by most active. We tend to focus on the earlier stages. We like Series A, B. We are also doing a lot of work in the seed stage because we think that trying to put together unique teams with unique opportunities to make breakthroughs in a whole range of diseases is important. We also have gone to the other end. We have done crossovers to IPOs and participated in IPOs. We manage a little bit under $1 billion by market value, which is a little less than 5% of the total assets of the company. And so we feel very good about, our position. We like to focus on leading edge. We're pretty involved today in kind of the next generation cell therapy companies, a number of them that have recently been formed. We've been pretty deeply involved with. Some of the gene therapy companies you saw, Spark, a gene therapy company based in Philadelphia, which is pretty unusual, just gets scooped up for over $5 billion. We're pretty focused on machine learning and artificial intelligence as it applies to the drug discovery process. We're also pretty focused on things. Can we detect at the just absolutely beginning cellular level before any metastases or any really aggregation of cells begin, the earliest signs of cancer beginning to grow within the cell. So there's so many areas. And as you know, Shannon, having an undergraduate degree in neuroscience, that the kind of the key to unlocking dementia and a number of the intractable neuroscience diseases really still has not been found. That has eluded literally every company so far, and we still don't see any immediate breakthroughs on the horizon.
Yeah, unfortunately, that is the case. But with companies that are investing in those areas with such a huge, significant unmet need, this is what I think will ultimately be over the next 5 to 10 years. I feel like we'll start to see the needle move a little bit in those areas. But yeah, that continues to be one of the marks that it just seems like many companies just can't hit.
It's been frustrating for sure.
So, Joel, we here at The Fool, we love games. Right, Shannon?
Oh, we love games.
Absolutely. So we're hoping you might want to play one with us today, and we'll keep it relatively simple. As we come into the home stretch of our conversation, thank you again so much for joining us here on the show. I wanted to do like a lightning round style game for our listeners that we'll call buy, sell, or hold. And what I'll do, if you're willing, is to give you a prediction. And then I'm going to ask you to rate it either a buy, a hold, or a sell. So if you agree with the prediction, that would be a buy. And if you're unclear or unsure, that would be a hold. And if you think there's no way that's happening, Todd, then that would be a sell. So what do you say? Are you game to play a game?
Of course.
Okay, great. So let's kick it off then. I'll tell you the statement, and then maybe you can tell me the buy, sell, or hold. And if you have a thought on it, please feel free to add. First point: in 5 years, venture capital for healthcare will be bigger than it is today.
Yeah, I honestly think that's an easy one. I think it's going to be massively bigger. And if you just look at the baby boomer, the aging of the population, not only in the U.S., but worldwide, and then you look at just the neuroscience area, absolutely bigger.
Okay, so we've got a buy on that, absolutely bigger. In 5 years, a new market will unseat Cambridge and San Diego, San Francisco, we'll say California. Cambridge and California as the hotbed for life sciences innovation.
No.
All right, so that's a sell. Those will remain the biggest marketplaces for innovation in life sciences.
Yep. Clusters take 25 years to grow. Nothing's going to happen in 5 years to unseat them.
Perfect. And then the last one. In 5 years, the NIH budget will be bigger than it is today.
Yes, it's almost $40 billion today and expect it to be bigger. There is one other factor that your audience should know. We spend less, the government funds less than $1 billion for ag tech research, and we're spending almost 40 on biomedical. And if you look at China, who just bought Syngenta, and we need to capture the lead research in the ag tech world too, because human health is not only fighting disease, but it's good nutrition. So I would say that's a big one we ought to pursue.
Joel, that's an awesome closing thought here, and something I know we'll probably dig into more. I think China, in a lot of ways, is on investor minds as we watch their emerging space and as the regulatory framework out there continues to improve. For you and your company right now, if you just had maybe one key takeaway that you'd want potential shareholders or current shareholders to know, what would that be?
Yeah, I think the one that I mentioned before, we're in a early innings of a biology revolution, and I think the company has the framework to double rental revenues in 5 years. I don't think there's a stock out there in the real estate sector that can match that.
Fair point. Fair point. Well, Joel, thank you so much for taking time out of your busy day to chat with us. I will say we would love to have you on the show. Maybe when you have those 5-year goals, check back on you, see how you did with doubling the revenue. How does that sound?
That sounds perfect. Thank you guys very much. It's always a pleasure.
Thank you, Joel. Thanks so much to you as listeners as well. And that's it for this week's Industry Focus Healthcare Show. As always, people on the program may have interest in the stocks they talk about, and the Motley Fool may have formal recommendations for or against. So don't buy or sell stocks based solely on what you hear. This show is produced by Austin Morgan. For Todd Campbell, I'm Shannon Jones. Thanks for listening, and Fool on.